we're probably going to do something similar to what's on the presentation, the Excel sheet that we sent on ISRG. It's either going to be it's like a sensitivity analysis to what we did, or what Mr. Shabbar did, or scenario number 2, which is we're going to give you a different company. We're probably going to do something similar to what's on we're going to give you a different company and request from you to do the same thing. Do me a DCF valuation similar to what Mr. Shabbar has shown you with 2 scenarios. Okay, and I'll give you the stage, Shabbar.
Thank you, Doctor. Good evening, guys. I hope you've had a nice week with Rian. I'm going to take off. Well, actually, I'm going to do a quick review on what we discussed last time. And then jump into the numbers as we have planned for most of today's discussion. So to review, we talked about an approach to doing DCF valuation, which involves looking at stories as well as numbers. The stories, or the narrative of any given business, is any information you may have about what the company and its industry is like today and how it may turn out tomorrow in terms of the market, or in terms of opportunities the business may have, how it may grow, the competitive landscape. Any qualitative data you have would be part of the narrative. Now, it's important to then translate this into numbers, into sales growth, operating margin, return on invested capital, reinvestment rates, all these numbers that we know that we generally associate with DCF, and coming up with some kind of fair value for the business. It's important to know the relation between the two, so that for a number of reasons, but perhaps the most important reason being that you can make a sensible and a grounded valuation. Because, you know, a really renowned investor with him having a meeting, and I was picking his brain about valuation, and I asked him how he does valuation, and he says, look, DCF is one of the tools we use, but we're careful with DCF because it's what he calls a blunt tool. It's powerful, but so long as you know its limits, right? It's important. You can plug in any assumptions and get any kind of value you want, but that doesn't make it a good valuation. One way that we're talking about today about making a really good, sound, grounded valuation is to use this idea of tying stories to numbers and numbers to stories, right? So that's an overview of what we discussed about this idea last time. We then jumped into Intuitive Surgical as our case. And just an overview, Intuitive Surgical is in the healthcare equipment, healthcare technology business. And what they make is the Da Vinci system, which is robot-assisted surgery. They are the leading business in doing this. They make these incredible machines that help surgeons perform safer, more accurate surgeries. And they've had an incredible past since 2000. You know, outstanding sales growth, returns on invested capital, and value they've created for their owners. Just a phenomenal story of the business. So we chose a really good one for our discussion. We talked a little more about the nature of its industry, so the fact that there are only 2 other players that are far, far smaller than ISRG. RAS market, RAS being robot-assisted surgery, is highly fragmented. You know, ISRG by far holding about 60% of the market share. And the nature of the industry being that it's, you know, it involves lots of patents, lots of R&D, lots of high-tech involvement. And then we dug a little deeper into ISRG and we discussed what makes it so great. And we discovered that it has these economic moats, 4 of them being switch cost, regulatory, Um, I remember there being R&D learning curve, and the last one was expertise network effect. So, you know, you guys have a pretty good picture. That's what we understood about the business. And these observations, as I said, qualitative observations, amount to the narrative part of ISRG. So we're gonna keep this in mind, and we're not gonna jump into the numbers part of ISRG. We're gonna see how this translates to the numbers and the DCF model for ISRG. I'm gonna take a pause here, Sulaiman, if you wanna ask questions.
Okay, guys, so feel free to ask any questions. The idea here is the narrative is as important as the model. The model can be brilliant, the numbers can be bulletproof, but if there is no storyline behind it, then the numbers are probably incorrect. The last class, Shabbar took you through the narrative, the story behind it. Now so that was the art part. Now we're going more towards the science part, which is the Excel sheet. Okay, make sure, guys, you're comfortable. I can cover as much as I can on the Excel sheet. That's the science part. The art part, Shabbar is here with us. If you have any questions, feel free to shoot it at him and make use of today's class. So same as last class. Any question, just raise your hand, and I'll take it and bring you in whenever it's a good time.
I'm going to wave hi to Abdul Bahsin. How are you doing, man?
Hello, Shabbar. Okay. How are you doing?
I'm all right. Good seeing you.
It's good to see you too.
All right, guys. So here's the Excel model that I put together, like I said, because this is an actual case back in March 2020, when I was like, ISRG because of the nosedive in price that it took, may have become a very interesting investment back in March. So notice the first part where it says narrative 1, riding the wave. I just gave the narrative a name, the narrative being a set of assumptions that you have. I came up with 2 narratives because I want to get a range of possible values for ISRG. Let's discuss narrative 1. What did I assume? Well, I started from the top. See, I thought about the total market and the size of it in dollars for ISRG. The total market is like the playing field, the field that ISRG operates in, right? So it's this space. Part of the reason ISRG is a good business to talk about is because at its core, the business model is simple. It's a single product. There isn't much complexity in understanding exactly where they operate, what industry they operate. We understand that fairly well. So we can fairly estimate the size of the market. I read a bunch of industry reports in order to get this estimation. I normally don't stick to one. I like to triangulate by reading more than one and see if experts more or less agree on the size of a market and then also about how it's going to grow. So I discovered that as of 2019, the RAS market was $7.7 billion. So you'll see that in cell B9, right? So I discovered that, I took that as a given. Now, I assumed as well that the RAS market is going to grow at a faster rate over the next 10 years than overall surgery. So I got an estimation saying the overall world surgery industry, or the world surgery market, if you will, is about $70 billion. Now, the RAS is about 7.7. It's just above 10% today. But all the experts agree that RAS is going to grow faster than overall surgery. Overall surgery really only grows at the rate of the world population rising, you know? So meaning that if only 1 out of 10 surgeries today are RAS based. More are going to be RAS tomorrow overall, right? This makes sense. So the best estimation I got of RAS's growth was about 10% year on year for the next 10 years. Now, because ISRG today is growing much faster than 10%, I said, okay, let me know if I lose you here, but here's what I did. For the first 5 years, I estimated that they're going to grow at 14%, okay? 14% every year for first 5 years. And then I assumed that it's going to slow down, because this is a general practice in DCF where you say the competitive advantage, all these business strengths of ISRG that we talked about are going to thin over time. The moat's going to thin, competition is going to come in. It's a fair assumption to make. So I said, okay, first 5 years, ISRG is really hot right now. They're going to be fine growing at a much faster rate than 10%, but then it's going to slow down. In the end, when you just assume that growth between today and what I'm assuming in 10 years, the net amounts to about 10%. Here's what I mean. If today, and this is an important assumption I made, I said they're going to continue controlling about 60% of the market over the next 10 years. This is quite a fair assumption. Meaning what? That if they control 60% of the pie, if that pie is going to be about 3 times larger in 10 years, and that's what 10% year on year means, by the way, that if it's $100 today, it's going to be $300 in 10 years. Sulaiman, do you have a question?
Yeah, I just have I just want to note out for the guys. So Shabbar, when we say $70 billion a year, when you say that's the market, that means every surgical equipment sold in the world is $70 billion a year. Is that right?
Yes.
Okay. So just for everyone to understand, guys, is to know the market, to know the playground that you're working with. The idea behind this number is to know how big of a market you're dealing with. So the main assumption Shabbar is pointing to here is all of the equipment, surgical equipment sold in the market is 70 billion. Okay, a lot of it is old school, things that they learned in the 80s, 90s, early 2000s. New school, how much? What's the percentage of it from today? Is it 11%?
Yeah, 7.7.
Okay, so what we're trying to show here is know the playground you're in. The playground I'm in, my clients, they make $70 billion worth of purchases, these hospitals, okay? Of these, who I'm really interested in are the people that are buying RAS, the robot-assisted surgeries, and that's $7.7 billion. So we have 2 tailwinds happening. Number one, the market is growing just because population is growing, so that's 2%. Number 2, I have something that's better than the market, okay? I'm the iPhone in the days of Nokia. So I'm gonna be growing at a relatively faster rate. So I just want the guys to be comfortable with these 2 numbers before we proceed. So yeah, you can take it from here, Shabbar, about the 14% and going forward.
Sure. Think of it like one way to simplify it is think of it as one customer. Say if ISRG had just one customer, an enormous, gigantic hospital that buys $70 billion worth of surgical equipment. But of course, it also does RAS. And 1 out of 10 surgeries of theirs is RAS-based. Right? What the industry experts are projecting is that this hospital, the one customer of ISRG, is going to do more RAS surgeries in 5 years and in 10 years than they do today. Therefore, RAS is going to grow faster than overall global surgical equipment market. So you'll notice the story link that I have corresponding to total market, where I've explained what my thoughts are. This is important, and I think Dr. Sulaiman would expect you guys to do the same thing for your assignment, where you come up with the number, but you have a story link. You got to explain your logic behind why you think a certain a certain metric, a certain market, whatever it may be, whatever number that is going to change the way you think it's going to change. If it's going to grow, it's going to stay the same, it's going to go down. So I'm going to move on to the next thing, which I discussed briefly. I'm assuming the market share of ISRG is going to be the same tomorrow as it is today. So 58%. And why do I do this? I defend this with the switch costs and the network effect that I talked to you guys about. Owing to this, I believe that they can at least, the least I can assume, that they can control that 60% market going forward. Okay. Now, next big thing is sales growth. And I've already discussed that with you guys. I'm assuming sales is going to grow at the same rate that RAS is. Why? Because the market share is going to, if the market share stays the same, mathematically, the industry and ISRG will grow parallel, right? And I assume this, part of the reason is that they are 60% of the industry today. So to think that their growth is going to match market is a somewhat fair assumption. Now, operating margin in any DCF, I'm sure you guys know, is a big, big lever, which really moves the needle. And in ISRG's case, again, owing to its the way it deters new entrants, the way it maintains its pricing power, I'm going to say operating margin is only going to lose out by about 1 or 2%. So what is 29% today, operating margin, I say is going to thin to about 27 slowly in 10 years. Okay, so that is an important assumption too. Now reinvestment is an important thing, but it's a little involved, so I want you guys to just be with me for a second and ask any questions you may have. Simply put, reinvestment is the money off the cash flows that a business generates. You take part of it and put it back into the business, often known as capital expenditure, but there's non-cash working capital too. You put it back into the business in order for more growth to happen tomorrow. Over the past 10 years, ISRG's reinvestment rate, or one way to put it is sales to cap ratio. So with every dollar that ISRG put back into the business over the last 10 years, at average, they generated $1.3. Every dollar they put in, they get $1.3 of more sales the following year. And sales to cap ratio reflects this achievement of ISRG. This is their efficiency in reinvestment. Dr. Sulaiman, do you wish to reframe this because it's a bit of a tricky concept?
What Shabbar is just pointing to is probably the main metric, or one of the main metrics of knowing a good business. So a good business is one where you put 1 KD and you take more than 1 KD, okay? And it depends on how much more than 1 KD, you know what a good business is. If you guys do this work in Kuwaiti stock markets, you're going to see a lot of companies listed in the stock market where the companies put 1 KD and they get out less than that. I mean, if you just do the homework pretty quickly, you're gonna identify at least five or six companies. These companies, good companies, are ones where you put 1 KD and you get much more than that. So for ISRG, it's close to brilliant. So every 1 KD they put, they get their 1 KD back plus 30% more on that. So the way that Shabbar calculated, and correct me, Shabbar, is you looked at change in sales.
Yes.
Or sorry, change in profits, right?
No, change in sales.
So change in sales and how much capital you had to put in to get that change in sales. Is that right?
Essentially, change in capital.
Yeah.
So if invested capital, there are multiple ways to calculate invested capital, but let's say we assume it's book value plus debt minus cash, which is one way. But anyway, the point is operating assets. So whatever assets are producing revenue for the business, you figure that out. I saw what that number was in 2019 for ISRG, and I saw what it was in 2009. And I noticed that it grew at a certain rate, the capital, and then the numerator was the change in sales. So change in sales divided by change in that capital gave me a ratio of 1.3. In any given year, you will see that this is a noisy number. Some years it'll be 0.7, some years it'll be 2. Generally, it makes sense to look at it a broad time frame. You'll get a clearer picture because it's not so neat in real life. But that's the idea. So what was the assumption I made for ISRG for the sake of our DCF? I said, last 10 years, they've done 1.3. Remember, I said, most of their growth tomorrow is going to come from Asia because North America is saturated. And they, if you read their 10Ks, if you read their annual reports, you'll see that they talk about new distribution centers for their machines that they're building in Europe and in Asia. And I believe that this will lead to some sort of scaling effect for them. And scaling, economies of scale, does lead to better efficiency in terms of sales to cap. So I assume that over time, it's going to grow from 1.3 today, slowly to 1.6 by 2029. If you want to get a clearer picture of this, look at the column L. Come down to L17, you'll see L17 all the way down to L28 is the sales to cap I'm assuming for the projected years. So 1.3 for a couple of years and 1.4 for a couple, 1.5, 1.6. I just assume a slow growth of that. More efficiency, more ability to generate sales dollars for every reinvestment dollar. I'm going to move on to the next and last piece, which is cost of capital. Remember our story of the Nightingale and the Hawk. The cost of capital is the uncertainty and the risk of whether there are birds out there. In the case of ISRG, I don't think I've mentioned this to you guys yet, but check this out. All this incredible business, and these guys are a debt-free business. If you look at their balance sheet, you won't find any bank debt. Absolutely unlevered balance sheet. Because they don't need to borrow the money. They've got so much cash flow. They've got more than enough for their reinvestment needs. So 6.5% in the 2020 environment, it's a US company after all, we've got unusually low interest rates, but that's a discussion Dr. Salman, I'm sure, is going to have with you about what to assume in the very tricky interest rate environment we're in. But I assumed a fair 6.5% for ISRG, and I'm going to stick to that, okay? So 6.5% based on CAPM, and that's our cost of capital. Now, that brings us to the end of the assumptions for narrative one and the story links that we have for it. Let's see how this plays out in the actual DCF. Right? I'm going to walk you through each column. Follow along with me. So you look at column B down to B17. You'll see that says all-inclusive global surgery market. That's the whole hospital.
Yeah, but do you mind if you zoom in? Do you mind if
Yeah,
you
of course.
Yeah,
of course. Let me know, Suleiman, if I should go further in. Some more?
Just a little bit, yeah, because now we don't need the assumptions as much, right?
No, we don't. Yeah, we're focusing on the
That's good. Yeah.
the exact numbers and how the DCF is playing out. Is this okay? Okay. So notice how it's $70 billion today, and I'm assuming a 2% growth. If you look at the cell formula, you'll see it's just a simple 2% growth over 10 years. And by 2029, I'll talk about terminal year in a moment. Let's just say 2029 for now. You'll see it grows from 70 to about 85. All right, that's a 2% growth year on year. Now, let's come to global RAS market, which is the playing field ISRG is in. Today, 7.7. Remember, I assumed a growth of 14% year on year for the first 5 years. By the way, if you want to see those details, go to column J and you'll see it here. 14 first 5 years, 12, 9, 7, 4, 2. Anytime you guys lose your way as to how the calculations are being made, just go to the cell, see the equation, you'll see the column mentioned. It says C17 that is growing at the rate entered here. So this is, I'm gonna mark this in yellow. Just a moment. And yellow means that these are input cells. This is a major assumption I made, and I've input it here. Over here, it's just playing out as a result of that input. So RAS market growing at this rate, that's our playing field. 7.7 billion turns into 20.5, which is about 3x, 3 times in 10 years. We assume a constant 58% market share all the way through our entire cap period, our entire DCF. And again, this is derived also. Revenues are going to play out today. Well, as I remember, we're assuming we're in 2020, March 2020. So the last 10K that came out gave us 2019 numbers, and that was about $4.5 billion. We assume that while market share remains the same, RAS grows at this rate, revenues will grow at exactly the same rate as market. Okay, so 14% first 5 years and so on. NOPAT, by the way, take a note, stands for net operating profit after tax. So it's the operating income we mentioned above, but with tax removed. Of course, there is also a tax assumption for in the case of ISRG, and I'm assuming an 8% tax rate. That can be found in the 10K. Dr. Sunderland, I suppose you can have a discussion with them about how to go about finding the tax rate of any given business.
Yeah, they actually did it, some of it in last class. And one of the assumptions we made was any tax rate that's less than 15% was a concern for us. It's like there's a reason why it's less than, but for ISRG, it's an exception, you're saying, Shabbar, right?
Yes, if you look at their basic statutory, meaning their fixed corporate tax rate, it's about 21%. But then they discuss how that comes down to 8 or about 10 if you want. And the way they do that is because a lot of ISRG's business and a growing part of ISRG's business is overseas, outside the United States, where they, in some cases, they pay lesser taxes than the US, and in some cases they pay no taxes. And when out, the effective tax rate turns out to be about 10%. Tax lawyers do this all the time because they're not just operating in one jurisdiction. I assume that that is going to stay more or less constant because I know that the future of ISRG's business is going to be more outside the US than inside. This trend is only going to go overseas. So that's our NOPAT with the assumption of the operating margin that we made above and reinvestment with the same assumptions I talked about. So I'm going to mark this again. This is also an input field. These are assumptions of NOPATs. These are assumptions of sales to cap. If you look at these cells, you'll see that it's just the numbers. There's no equation because these inputs are acting elsewhere in the DCF. This is just, I've entered the years here in order for calculations. And after you've entered these numbers, you come up with free cash flow. So what's free cash flow? That's F17, which is this NOPAT, with the reinvestment removed, and you have free cash flow. Every year's free cash flow is right here. That's what we expect ISRG to generate. And here in column N, those free cash flows have been PV'd depending on the year they're in at a discount rate of 6.5% that we assumed, right? So those are the PVs of our free cash flows of our main cap period, which is 10 years. Okay, I'm going to take a pause here. If there are questions, guys, please ask me.
اوكي شباب، فاي واحد عنده استفسار خليه ياخذ راحته. الحين عندنا كم شغله مغطينها، ف it's supposed to be يعني اذا انتم ضايعين عادي، كلنا ولا في اشياء مو فاهمينها عدل ماكو مشكله. ف على راحتكم feel free to ask any questions. تفضل احمد.
السلام عليكم. Doctor, present value for future cash flow. It is the discount for future cash flow.
You mean column N, Ahmed, right?
Yes, column N. It is discount from column H.
Okay, Shabbar.
Yes, that's correct. That's correct. So say, for instance, in the case of H17, we've got $832 million as free cash flow for 2019. No, I tell you what, let's take a future year. Let's say 2022. And we forecast that ISRG is going to generate $1.2 billion of free cash flow that year. This is basic DCF equation. If you look at the corresponding N row, N20, you'll see that number, 1184, has been taken and discounted at 6.5% given year 3. And when you do that, when you discount 1184, given that it's year 3 at 6.5%, you'll end up with 980 at today's dollars from 2022. Does that make sense, Ahmed?
Yes, that's clear. Thank you.
Okay, تفضل عبد المحسن.
Mr. Shabbar, as a financial analyst, I'm sure that you have done many investment theses for many companies. My question is, how accurate are these assumptions usually?
That's a really good question, Abdul Mahsen. I'm glad you asked. It's important to remember that this is not a crystal ball. This is not some accurate, precise view of the future that we're getting here. That is not how you do well in this game. It's important to remember you're making a bunch of assumptions here. It's important to know how to keep those assumptions grounded. Remember, we talked about the story. If you're asking me how accurate, it's as good as your story is. It's as good as how grounded you keep your narrative. If you don't let that get away from you, if you don't take on, and with experience, you'll get a better picture of what a normal DCF looks like.
Yes.
And what something out of control is. We haven't completed our exercise yet. When we come to the end, we'll see what value we're getting from this. And then we'll see how that actually plays out. But the tool is as good as your assumption, Abdul Mahsen. So yes. The idea is to learn more about what really the business does, what the story is, what the different business scenarios that can work out for it. You keep these in mind and your valuation won't be crazy. Otherwise, we can take this and come up with any value we like.
Yes, I'm sure of that.
So you can do a very bad and very poorly done, no matter how black boxy and powerful your Excel model is. That's not where the intelligence lies. The intelligence lies in your ability to understand the business, its industry, and make good sound assumptions. Another way, by the way, that you protect yourself is by coming up with a range. All right, I read this when an investor I admire, it was in a book, one of his, where he's discussing an approach. And he says range is a very powerful psychological thing as well, to think in ranges, to say, yes. No, I'm not going to just come up with one number, and especially this is a personal thing. I know there are other investors who may argue against this, but when coming up with the business value, don't do first decimal place and second decimal place saying, oh, I believe the value of this company is 480.34.
Yeah.
Because it sends a message to yourself when you come up with that precise a number, that you have some ability to tell how the future is going to work out to that accuracy, to that precision. Nobody does. And it's a waste of time to think that we do. We don't. Instead, if you take the opposite approach, which is you say, no, I just want a broad idea. I'm going to come up with 2 reasonable narratives and see what range it gives me. It says, if it tells me it's between 520 and 550, okay, that way I know it's going to work out this. If you then find the stock, the business trading at 450, you say, well, my range is so far, it's so far below what I reasonably assume for this business. You take a bet. You want to be directionally accurate, Abu Hassan. You don't want precision. You want to be directionally accurate. In this business, when playing the long game, holding a business, buy and hold strategy, fundamental investing, you'll do well. You'll do well. That's what the best guys, the best practitioners have done. That's all you need to do. No accuracy, no precision. Does that make sense?
It makes perfect sense.
Thank you.
Thank you very much.
شكرا يا شباب. Thanks Ahmed and Abdul Muhsin. Anyone have any other questions? We'll continue the slide. We're good. Okay, Shabbar, you can take it.
Okay, now that we've seen how the free cash flows, discounted free cash flows over 10 years is going to work, we come to the last part of any DCF, which is the terminal year. So we say, once again, the terminal year free cash flow is this. You guys can look at the cell to see how I came up with it. It's the terminal growth rate, I'm assuming, is of 2%. That's generally reasonable to make it the same as risk-free rate. I continue to assume, which is a decent assumption for ISRG, that it continues to control a large part of the market, that's 60%. And then I discount that free cash flow over here, come down to D30, where I discount it. Again, this is from the textbook. You take the 6.5%, which is the cost of capital for the denominator, and subtract risk-free rate. The numerator is, of course, the F28, which is the NOPAT assumed for the terminal year. And you get a terminal value of about $72 billion. You take those free cash flows that we did earlier, sum them up, you'll get 38. No, I beg your pardon, I made a mistake there. The terminal value, the $72 billion, is as of 2029. You have to discount that too, down to today. When you do that, you get $38 billion. The free cash flows we talked about earlier amount to about 13.8. Together, the value of your operating assets, you add those together, you get $52 billion, right? As of this narrative, remember, as of this narrative, we're getting a $52 billion. I know I said that the company has no debt. It doesn't, no bank debt, but there are operating leases, which are off-balance sheet liabilities that best practice says you should assume as debt. In the case of ISRG, it's tiny, it's just $500 million. So I put it in there because it's important. You subtract that as you do in any DCF, you add the cash in, they've got about $3.2 billion of cash. And net, you get a value of 54.9, about $55 billion. You divide that by the number of shares outstanding today, which is 116 million. And I got a value, again, back to March 2020 of 474 for narrative 1. Now, at the time, ISRG was trading at 438. That is to say that I observed a discount of about 10%, about 8%. Pretty interesting for a powerful, formidable business like ISRG. They usually trade much, much higher than their.
Shabbar, do you mind to zoom in just a bit also?
Sure, sure.
Yeah, brilliant. Thank you.
It was interesting because it indicated to me that I may be onto something interesting. Okay, now, in the interest of time, I'm going to jump to narrative 2. And there's not much to discuss here because I kept most assumptions the same. I wasn't going to change anything about the total market. That remains what it is. I kept my assumption about operating margins the same too, because I do believe that that's something that's not going to change very easily, those advantages that ISRG has over its competition. Reinvestment, same assumption. Cost of capital, same assumption. So what did I change for narrative 2? The narrative 2, I named that. Go ahead.
That's the point. So January 2020, that we would have come up with similar numbers also, right? To come up with a valuation of 474. And how much was the price in the market? So it was off.
In January?
Yeah. How much was it like in January, December?
Let me see. I can tell you it was much higher than 438.
Yes. So the idea is there are always good companies out there. The issue is they might not be good investments because they're pretty expensive. And there's like a short window of time where the market gives you that opening. Yes. It's like, okay, great business, great equipment, going to do great in the next 20, 30 years. You want to buy it at this price or no? And usually these windows are very short. I don't know, Shabbar, if you want to talk about the windows, how wide they are. Usually, how many days, weeks do they give you? I'm quite sure it's not years.
No. It could be, but usually for very high quality businesses that I look at. Now, I can't quote an academic study on it. I'm sure something is out there. But I would say it could, I don't want to throw a number out there, but it could be as short as a month. It could be as long, often as a few months. Why? Because it's usually quarterly reports that leads to corrections. It's reports that come out about the fundamental business growing, or news coming out, other related stuff, boards changing, CEO changing, exciting news about technology coming into the market, affecting the industry. That sort of thing has a cycle of about 2 quarters, 3 quarters, something like that. If it's a very high quality business that's watched by many, many very intelligent analysts, you can be sure that if you get an opportunity in the market, it's going to be short-lived. You got to move. This is why we put great businesses on our watch list, and ISRG was one of them. We may even set notifications. We set the tools that allow us to just let us know if it comes into a certain range, and it'll let us know. But otherwise, we're just watching for these great companies to go into. And you want to wait for a time like March 2020, which doesn't come about much. That's why patience goes a long way. To answer your question, Sulaiman, the price, say in mid-Jan, ISRG was trading at $600, Jan 2020.
Okay.
So we're talking 40% higher than that price in March 2020 that I was looking at. Much less exciting than same business. You're talking a difference of 3 months. It didn't make any damn difference to ISRG's business and their fantastic strengths. But as an investment, yes, big difference.
And Shabbar, I don't think people are going to get less sick. I don't think people are going to get. They're not going to choose not to do the best operation once they need it. So yeah, the business was cement. Yeah.
Precisely. Surgeries are not going away. The idea, people are going to fall. Unfortunately, people are not going to stop falling ill. We're not going to stop having these problems that human beings face when they age, when they incur diseases. And it's not like these technologies are so fast moving where in 2 years there's going to be something radically different. We're going to be performing surgeries using AI. It's not going to work like that. This is what's called a secular technology. It's going to go on for some time. And but let me come back and finish our narrative too, before we come to the top of the hour. I kept all these things the same: market growth assumption, operating margin, reinvestment, cost of capital. What did I change? I called narrative 2 runaway horse, which is to say it's a bit more optimistic than narrative 1. And here's where the optimism came. I said that 58% is going to grow. That 58% market share of ISRG, they're going to control more of it tomorrow. In this field of theirs that's going to grow at 14% or at 10% rather over the next 10 years, I say more dollars are going to go, more RAS dollars are going to go towards ISRG. So if you, and they're narrative 2, guys, go to J53, you will see how, let me, not J, but I. You will see that I assume the same thing in J for the growth of RAS market, but for the ISRG, it's faster. I assume 19, 18, 17, you can compare with the other. 2 is the change is here, that 58% slowly grows up to 70%. And for me to assume that 60% market share is going to be 70% is the core assumption for this business, owing to the scale effect and owing to increasing R&D learning curve and the fact that they'll be able to draw more and more talent related to this technology into ISRG. So that is the key assumption, how sales are going to grow faster rate than the market and therefore a higher market share. All of the things that the way free cash flows turn out, the way it's discounted, the rate, it's all the same. Terminal, PV, value operating assets, subtract debt, add cash. Now, when I did this, instead of what was $55 billion, I got a net of 63.5. And that, when you divide it by outstanding shares, you get 548. So, Abdul Mohsen, back to the point we were discussing, for the case of ISRG, the range we got was 474 to 548. And it was trading at 438 at the time when I was looking at it. So here's my recommendation that I'm gonna just read out to you guys. This is what I wrote in my report. Surgery as a means to investigate and treat pathology, which is disease, dates back many millennia and continues to be an essential branch of medicine. There is widespread agreement on the benefits of RAS, driving a growing demand from hospitals worldwide. RAS's complex and life-critical nature yields a winner-take-most landscape. The clear leader in this space is ISRG and has been over the past 2 decades. The 2 narratives presented in this report show an IV range, an intrinsic value range of 474 to 548. Now at 438, the stock offers an 8 to 20% discount to the value that we estimated here. Therefore, I recommended a buy. TSR is total shareholder return, which is a slightly different exercise. I'm sure you guys may come across it in Dr. Sulaiman's class or any other in your major, but it's a way you calculate what return a shareholder can expect. And I estimated something like 13% year on year over the next 7 years of holding this fantastic business. And in most people's books, 13% year on year is pretty good, especially for owning a fantastic business like ISRG. That brings me to the end of our DCF discussion. Happy to take questions, guys.
شباب free to ask any questions. اللي عنده أي سؤال يقدر يرفع ايده. تفضل عبد المحسن.
I just looked at the price of the stock today. Currently, it's 868. And I just wanted to know, do you think it's currently overvalued or?
You ask a very important question that we within our company are asking at the moment, Abdul Mohsen. And in order for me to answer that question, strictly speaking, I'd have to look back into the business, see what happened in the last year, because their 10K recently came out. And the bottom line is they were affected by COVID. The sales actually went down. Notice how COVID was around in March 2020, but I didn't assume that, and it's not important, because as long as that long-term story remains the same, you can still count on that business. But to answer your question, do I believe it's overvalued? Yeah, I probably do. And I'll tell you why. I made certain optimistic certain optimistic assumptions about the business here in narrative 2. I called it runaway horse, and I got 548. It's trading at 860. That's 50% higher, if not more, but 60% higher than that optimistic scenario of mine. I have a tool, this is a little off topic, but I have a tool where when I see the price of any given business, without having to do DCF, I can use DCF as a tool without any assumptions of mine. I can sort of unpack that and see what assumptions the market is assuming for that price. So for instance, if the market is saying $860, and I assume the market thinks that 860 is the intrinsic value of ISRG today, what assumptions are built in? And when I put it into that model recently, by the way, 3 weeks ago, it was 890, but that's not the point. The point is, when I put it in, I'm getting ridiculous assumptions about ISRG. So to answer your question, yeah, our client to whom we recommended this a buy got a return of something like 100% in a year, which is crazy good. But it's also something, when this kind of thing happens and there's a big, when the price skyrockets, it also makes us cautious, because maybe it's a good time to sell and get out of it. Not that ISRG has changed at all as a fantastic business, but it may be a better time to re-enter another point. That's another portfolio management discussion. But to answer your question, yeah, it's probably overvalued today.
But
Sarah has
it still has huge potential. Looking at the numbers you just did, it still has a huge potential.
As a business?
As a stock and as a business.
As a stock, I would be wary, because when this unusually bubble-like market that we're in, when it cools down, or if there's a market crash, that 860 might correct. Mr. Market may come to his senses and go like, yeah, it's a great business, but 860 is a bit crazy. And it may correct to some kind of reasonable range that we've talked about here today, around say 470 to 550 or even 600 in the best world out there for ISRG. Well, what is it saying? 860 is saying, okay, nobody else is going to make grass over the next 10 years. Okay, and suddenly the population of the earth is going to grow to 17 billion people, and more people are going to be sick tomorrow than they are today. It's crazy. So as an investment, I wouldn't buy in today. It's too hot. The assumptions are too high. Great business, you may not do well as an investor if you enter today. You might want to wait. But if you're asking me if there's a lot of potential as a business, I don't doubt it. In a year, nothing has changed for how great ISRG's future is probably going to be.
Thank you very much.
Thank you.
شكرا يا عبد المحسن. تفضلي سارة.
Hello, first of all, thank you. And my question is, well, the whole market today is overvalued. Stock prices are rising, and it's not, it doesn't go with the actual economic situation that's happening. So stock prices are high, however, the world is still at standstill. So everyone says a crash is on its way, or a correction is on its way. And that happened in March. For a week or so, the stock market crashed, recovered very quickly. So do you think that if another crash happened, it would recover as fast?
Sarah, thank you for the question. There is nobody knows the answer to this question. There is no tool. The best thinkers out there who write about, the thought leaders on bubble territory, markets, and so on, even they make very broad assumptions and tell and mention the fact that we're talking about macroeconomics that are so incredibly complex that to say with any confidence about how this is going to play out, or is there going to be a crash? They're fairly sure it's going to be. When is it going to be? Nobody knows. When it happens, how long is it going to last? Nobody knows. It's best. I don't play the macro game, so I'm not in any position to answer this question, to predict. But I would be wary if anybody is. I would be wary of somebody who tells me with any confidence that this is what's going to happen. I'd be like, how exactly are you doing that? The best approach is to have a very broad and in the market today, and to try not to do macro estimations too much, to think more micro, to think at a business level, and to see if that macro environment gives you an opportunity in investing. There's a quote I'm going to leave you with of Charlie Munger's, Warren Buffett's partner, where he says, micro is what we do, which is at a business level. Micro is what we do, macro is what we have to put up with. So just remember that. That's all I have to say.
I think that's like the best sentence to this class at. Shabbar, thank you very much for your time, and I love the idea. So micro is what we do. Everything we're doing here, we're concentrating on the business, we're concentrating on the companies. Macro is what we have to put up with. We cannot model COVID-19. We cannot model wars. We cannot model a lot of things. So we just want to make sure that the businesses we own, using these tools that we're trying to teach here at university or learn at university, are going to support us whenever we want to make these micro decisions. So شباب إذا في أي واحد عنده أي استفسار أخير يقدر يسألنا. If not, I'd like to personally thank you, Shabbar, for your time. Thank you very much. And on behalf of everyone in College of Business Administration and our FIN 340 class, we really appreciate having you here today and on Monday. And if you ever want to pass by, you have a place here in Kuwait University.
So kind of you. I appreciate you inviting me. I've been thrilled, like I said, to be here. It's great seeing you guys. Thank you for all the great questions. And, you know, ideally, I would have loved to see you guys in person. Honestly, it would have been so much more fun. But when things open up again, hopefully I can come visit you guys.
Thank you very much, Shabbar. It was a pleasure meeting you.
Thank you so much.
Thank you.
So this is it for today, guys. We'll see you, inshallah, next week. And by the time we prepare the assignment, I'll keep you guys posted. I got a couple of ideas from Shabbar that I'll probably add to the assignment tab, but we'll probably have it done by tomorrow. Me and Ms. Wadha Al-Atiji will try to prepare it by tomorrow and send it over to you guys. Okay. Thank you, everyone. Thank you, Shabbar.
Thank you very much. Good night, guys.
See you all next week and see you next time, inshallah, Shabbar.
Inshallah.
Inshallah.
Nice one.
Have a good night. Faman Allah. Faman Allah, ya Shabbar.